If you went to sleep late Tuesday afternoon, around 4 p.m. Eastern on February 4th, it probably felt like silver had finally stopped bleeding. The candles were tightening. The selling pressure looked like it was losing steam. For a moment, it seemed as if the worst of the panic might be behind us. Then February 5th arrived and completely changed the tone. Silver was slammed again, hard. Reuters reported that spot silver was down roughly 13 to 14% by late morning, trading near $76 and briefly touching levels close to $72. In the wider commodity complex, Reuters also described silver dropping as much as 15% during the sell-off. And what makes this particular stretch of time, from February 4th around 4 p.m. Eastern through today, so important is this. This was not a slow, orderly repricing. This was not a gentle reassessment. This was forced activity. This was leverage being flushed. This was exchanges stepping in. This was large players reacting inside a stressed system. And there is one development out of Shanghai that stands out as especially important and absolutely needs to be understood. The Shanghai Futures Exchange released a public notice stating that 6 groups of accounts tied together by what they call an actual control relationship exceeded intraday opening volume limits on certain contracts. Because those thresholds were breached, the exchange imposed restrictions that prevent those customers from opening new positions in the affected contracts. At the same time, Bloomberg reported that a Chinese billionaire trader, Bian Jiming, has built the largest net short position in silver on the Shanghai Futures Exchange. In simple terms, an enormous bet that silver prices would decline. So in this video, we are going to do one thing very carefully. We will walk step by step through what is confirmed, what is interpretation, and what the possible implications are, especially for people who hold physical silver versus those trading paper instruments. Stay with me through the end because the details matter.
Before we begin, a quick disclaimer. This content is for educational and informational purposes only. It is not financial, investment, legal, or tax advice. I don't know your personal situation, objectives, or risk tolerance. Nothing here should be taken as a recommendation to buy or sell any asset.
Let's start where this story really begins. Shanghai. The Shanghai Futures Exchange issued a notice dated February 5th stating that 6 linked groups of accounts violated Article 16 of its trading behavior management rules by exceeding intraday opening volume limits. As a result, the exchange restricted those customers from opening new positions on the related contracts. A few key points to understand. An actual control relationship means multiple accounts that the exchange believes are controlled by the same entity or coordinated group. Intraday opening volume limits cap how many new positions can be opened within a single trading day. A restriction on opening new positions means the exchange is cutting off the ability to add new risk in those contracts. This is about opening volume. Opening volume equals creation of new exposure. It is aggressive positioning. Does the notice accuse manipulation? No. Does it explicitly say shorting? No. Does it say these accounts caused the entire price collapse? No. But it does confirm that concentrated abnormal activity occurred and was serious enough for public enforcement. That alone is significant. In many Asian markets, public enforcement actions carry weight. They are not routine announcements. My interpretation, this strongly suggests that trading behavior became disorderly and concentrated enough that the exchange felt it had to step in to cool things down. Now add the second Shanghai data point. Bloomberg reported that Bian Jiming, known for large, profitable bets in precious metals, currently holds the largest net short position in silver on the Shanghai Futures Exchange. That means he benefits if silver falls. Why does this matter in this specific window? Because when a very large short position exists in a fragile market, price behavior changes. Every bounce becomes a selling opportunity. Every attempt to stabilize runs into overhead pressure. In thin liquidity, large orders move markets more than they normally would. This does not mean one person controls global silver prices. It does mean that big size in a stressed environment can heavily influence short-term price action. So now we have two Shanghai facts that rhyme. The exchange restricted linked accounts for abnormal opening volume. A major trader holds an exceptionally large net short position. Not proof of conspiracy, but very strong evidence that Shanghai flow was not business as usual. Next, let's move to Europe. During this same window, a key macro narrative shifted. Reuters reported that commodities broadly sold off as geopolitical tensions appeared to ease, citing potential U.S.-Iran talks and a constructive call between U.S. and Chinese leaders. Markets trade headlines first and analyze later. Talks equals reduced immediate fear. Reduced fear often leads to liquidation of crowded safe haven trades. Oil fell more than 3% on easing supply concerns. Silver, gold, and other metals were swept into the same wave. In risk-on and risk-off environments, commodities frequently move together regardless of individual fundamentals. Now we transition to the United States session. By the time U.S. traders were active, Shanghai had already shown instability. Fear premiums had softened. Liquidity was thin. Volatility was elevated. That brings us to the third major force, margin pressure. When volatility spikes, margin requirements tend to rise. Brokers tighten, exchanges tighten, risk managers tighten. Traders are forced to reduce positions, not because they changed their long-term outlook, but because they must raise cash. Reuters stated that investors were liquidating precious metals holdings amid a stronger dollar and broad market sell-offs. One strategist pointed specifically to margin-driven selling as traders covered metals positions due to losses in equities. That is classic liquidation behavior. When portfolios are under stress, people sell what they can sell. Futures, options, and ETFs are liquid and fast. Physical metal is not. India experienced the same dynamic. Reports indicated that MCX's clearing entity imposed additional margins on bullion futures, including an extra 4.5% margin on silver contracts. Higher margin equals more cash required. More cash required equals forced selling for those who cannot meet the call. Forced selling in a thin market accelerates declines. Now let's address the critical distinction. The price flashing on your screen is primarily a paper price. Futures and derivatives dominate short-term price discovery. They are highly leveraged. Leverage is why prices can drop through levels rapidly. Physical silver does not get margin called. A 15% paper drop does not mean silver suddenly lost its industrial value or monetary relevance. It often means leverage is being flushed. Today's flush had multiple layers. Shanghai enforcement, large short positioning, easing geopolitical headlines, stronger dollar, equity weakness, rising margin requirements. Now here is where the paper versus physical disconnect becomes important. During this same window, COMEX depository reports showed meaningful inventory movements, including more than 3 million ounces shifting out of eligible category around February 4th. To be precise, metal moving between eligible and registered does not necessarily mean metal left the building. But during a paper liquidation event, large inventory adjustments still matter. They show that physical metal is actively being repositioned while paper markets are unraveling. From a physical buyer's perspective, days like this often look very different than a futures chart. Paper traders are forced out. Physical buyers start looking for deals. Premiums and availability become more important than spot price. So what are the implications? For long-term physical holders, the underlying reasons for owning metal have not changed. Debt levels have not disappeared. Currency debasement has not stopped. Industrial demand has not vanished. What we are witnessing is a leveraged paper market purge. Volatility cuts both ways. For disciplined accumulators, sharp sell-offs can present opportunities rather than signals of failure. The key is to stay rational, avoid emotional decisions, and understand the difference between paper price action and physical reality. Thanks for sticking through this deeper breakdown. When markets move violently, context matters more than headlines. Happy stacking.